Hi everyone, this is Mehul Mehta and welcome back to my YouTube channel. So for today's podcast, we have a very special guest. His name is Jason. So let me give you a quick introduction about Jason. So Jason is the founder of PyCont News. So PyCont News has more than 50,000 followers on LinkedIn, and Jason, is also an expert in the field of algorithmic trading. So all the posts that you see on PyCont News is all about algorithmic trading. So in this podcast, we'll dive deep into, what is algorithmic trading, what are the steps in building a algorithmic trading. And, and also one good news is he has published a book on algorithmic trading. So we'll deep dive into, okay, what does the book covers, what are some things that we can learn from the book. So in this podcast, we are and honestly, I have very little experience about this area. So Jason, I'll be asking a lot of questions on this.
Yeah, my pleasure. Thanks, Mehul, for reaching out and very excited to do the pod with you today. Thanks a lot.
Sure. Thanks, Jason. So Jason, I'm just curious. Okay, can you tell, in easy words or, someone who's beginner in this field, like what is algorithmic trading?
Yeah, well, let me maybe start with what it's not.
Okay.
Algorithmic trading is not the same as high frequency trading. A lot of people kind of put the two together. High frequency trading is, you know, trading millions of shares a day in like microseconds and milliseconds. That's not what we're talking about here. Algorithmic trading can be as infrequent as every month. Okay. And I think it's easiest to illustrate algorithmic trading in contrast to what's called discretionary trading. And you might, if you're just getting started in the markets, you might pull up a screen, you might pull up some charts, you might draw some lines on your chart, and you might say, that looks like a good time to buy when these two lines cross, or this thing turns red, or this shaded area becomes purple. You might think to yourself, that looks like a good time to buy, and then you buy. That's a discretionary trading pattern, right? You are looking at patterns, you're using your own human intuition to decide when to buy and trying to determine the patterns of the market using your own like intuition and gut feel. Algorithmic trading is quite simply using computers to do that for you. And you're pumping in market data or you're pumping in alternative data into a computer algorithm. And that algorithm is designed to decide for you whether you are going to buy or whether you are going to sell. Now, the art, of course, is to decide what goes into that algorithm. And I think maybe we can touch on that in a little bit.
Okay, perfect. Yeah, that sounds good. What are the steps of it? If let's say I have a financial data, let's say I have, I downloaded, let's say, or I connected an API or something like that. So, like, can you walk us through the whole process, from scratch till the end of it?
Yeah, absolutely. And you might remember from your like primary school, the scientific method, right? I mean, I think the first thing you learn in your very first science class when you're a kid is the so-called scientific method. And that kind of goes like you have an observation about the world, you form a hypothesis about why that observation is happening, you collect data, you use that data to test your hypothesis, you draw conclusions on what your tests tell you. The algorithmic trading process is very similar. And in fact, we try to get as close to that process as we can. With trading, we have an observation of the market. We look at the market and we think we found some edge or some market inefficiency that we think we can repeatedly trade to make money. We collect a bunch of data. We test that hypothesis with what's called a back test, right? So you're running your strategy on historical data that has appeared in the past. We can absolutely talk about back testing as well if you'd like. And then depending on your results of the back test, you make a decision whether it fits your risk profile. You either optimize some parameters potentially. You make sure that your strategy is so-called statistically significant. So I know that you're doing a lot of modeling. So I think your listeners will probably remember what statistical significance is. A big problem with traders is that they just get lucky and they might make money on one or two trades, and then they assign that luck to skill. That's a big no-no. We want to use algorithms to generate data and try to assess whether our strategy is statistically significant. And then if that's true, we apply some money to our account and we start executing that trade on an automated basis with computers.
Perfect, perfect. So, like, how tough is it? Because I understand the difference between trading and algorithmic trading is in trading, you basically call a broker and say, okay, I need to invest this money into, let's say, XYZ stock. But I guess in algorithmic trading, it's done using programming languages. So, like, how different it is the setup, or let's say, how challenging is the whole setup of basically from scratch if someone wants to, because a lot of people know Python. I know Python, to be honest, but I have never deep dive into algorithmic trading. So, like, can you walk us through the process? Like, if let's say if someone wants to start with Python, like, what's the whole process of it?
Yeah. Well, nowadays, I mean, you don't necessarily need to make a phone call. You've got apps and all sorts of different platforms that you can be trading on. I think the difference, though, is to your point, is you're either kind of looking at the screen and making decisions on a discretionary basis, or you're hooking up your code to make those decisions for you. Now, the actual setup is not necessarily the hard part. Any intermediate to advanced level Python person or coder can set up the stack, right? The challenge is to avoid the biases that lose you money. A big one is, overfitting your model and thinking you have some edge when you actually just have a model that's fit to noise. And the other then is of course coming up with strategies. And I think coming up with strategies is where most beginners kind of angle towards technical analysis because it's sexy. You see the lines on the charts, and you've got survivorship bias online and Twitter and LinkedIn, and people saying, I made $1 million and here's my moving average strategy. Of course, for every one of those people, there's thousands and thousands that made no money. And that's where I think a lot of beginners start. And I would caution and suggest that you instead try to think about finding patterns in the market that actually model asset mispricings. Okay. Now I know that's kind of a mouthful and it's kind of jargony, but this is really the essence of algorithmic trading, is that you're trying to find mispricings in the market and taking advantage of those mispricings. So that's kind of where you should be starting. The best opportunity is to open a paper trading account, start trading risk-free, observe the market, and start to try to think about how to gauge, measure, and exploit these market pricings. And then once you've got the hard part done, then you can just wrap all the code around it.
Right, right, right. So you mentioned about, people, all the freshers starting with doing technical analysis and putting in the money, and then they find out, okay, they lost a lot of money just, basically on what they thought, but it came out to be reverse, or, basically they betted against what they thought. So I mean, like, so you mentioned about the models, right? So
Mhm.
is it like a linear regression models, or like what kind of models actually, are used in algorithmic trading?
It's a good question, and it's unfortunately a really difficult to answer because it all depends on the type of strategy that you're trading. Okay, so let's think about a like a pairs trading strategy. So a pairs trading strategy is you have two, let's just say, stocks that have a relationship. Let's say stock A, stock B, right? So they kind of move in tandem. They're always moving together. Maybe they're a supplier and like a supplier like Foxconn and Apple, right? Apple buys a lot of iPhones from Foxconn. Foxconn produces iPhones from Apple. And then there's a temporary dislocation in that relationship, and price A goes way up and price B goes way down. And it's your job to model that normal relationship. And if that normal relationship deviates from that normal, if there's an anomaly, then you need to have your attention drawn to it and execute your trade. So in that example, it could just be a simple time series model, like ARIMA models are very popular to model the stationary of a time series. You know, pretty basic-ish statistics can actually get you really quite far. Um, Linear regression actually is used quite a bit in simple hedging. Um, Even in pairs trading, you can come up with a beta coefficient,
Yeah.
and that could be either your hedge ratio or your pairs ratio. Linear regression is ordinary least squares is a very common way to do that. So that's kind of what we're talking about. You can also use anomaly detection algorithms. So if you have a normal relationship and that relationship breaks and all of a sudden that spread just blows out completely, that would be an anomaly, right? And I know that Facebook has a profit time series library that detects anomalies. A lot of these libraries detect anomalies. That could be a good start too.
Also, like, so I heard, like, couple of research. I was seeing couple of research papers using machine learning and neural networks.
Mhm.
But the issue with neural networks is no one knows what's happening inside, kind of black box model. So is it something that you recommend, or like is it something that you yourself use, or like, or are you using, the basic, I mean this basic statistics models like linear regression, or let's say time series model, or you are also diving deep into the machine learning and neural networks?
Definitely not neural networks. I mean, there's lots of papers and it's very sexy to like train a neural network on some price data. The problem with the price data is that it's non-stationary, it's very nonlinear, and there's not actually that much information in the price data. So when you're training a deep neural network and you come out with some result, like I don't think anybody's doing that with pure price data. Okay. Now, there are different strategies like factor portfolio strategies where you're trying to detect, like, think principal component analysis, right? So, PCA, you run a PCA analysis on a set of data, and PCA tries to figure out what are the drivers of those data. And that's a really popular way to take a lot of features and condense them down into a few features, which are then more tradable. That's a really common kind of machine learning method. Another common machine learning method is just basic predictive models. So you've got a lot of factors, and you can kind of plug them into a predictive model and determine whether your factors collectively have some predictive power on future prices. There's all sorts of alternative data. You can think about image recognition. There's actually a story about they're taking conference calls and they're analyzing the emotional state of the CEO as they're talking using like some sort of fancy ML. And they're trying to understand if he sounds nervous, if she sounds upset, and then they're making trades based on that. So there's all sorts of alternative data that people are using and applying ML to, but the price data there's not much there in the price data.
Right, right. Also, like the whole process, is it like, okay, once you get the data, then you basically build a trading strategy, you backtest the strategy. If you backtest on, several time frame, and then you implement that strategy. Is that the whole process, or am I missing anything in this?
I mean, that's the high level process, right? But you can appreciate that there's a lot of nuance that goes into back tests. I think a lot of people with the back testing, it's very easy. So I'm picking on back testing. So to answer your question more succinctly, yes, that's the high level, kind of very highest level perspective. You have an observation, you form an idea, you collect some data, you model up that idea, you test through the back test process, you iterate on your idea back and forth until you get something that's reasonable. And then, ideally you're paper trading that for a while, and then you move to live execution. That's the high level process. But to kind of dig into the nuance of backtesting a bit, most people go wrong with backtesting because they think about backtesting as a way to optimize input parameters to achieve some maximum P&L. And the market is so noisy, and it's very unlikely that you have actually captured a market inefficiency, that you are very likely fitting your model to noise, random noise in the market. So when you do this process and then you have your parameters that you think are giving you some 10x P&L on your portfolio, and then you try to use that parameter set in the live market, the whole strategy falls apart and you lose money. That's because you've overfit to the noise in the market. And now modern technology can put these back tests so fast, and you can run so many rounds of optimization, that there's a huge moral hazard in people doing this backtesting process the wrong way. So there's an entire art to the backtesting process that I can't gloss over. So yes, that's kind of the high level process, but there's a lot of nuance at each step.
Oops, sorry. Also, I just want to focus on the first step. Let's say with the data, right? You get the data. So what are the issues that you face with the data? Like, have you ever faced any issues with the data? Like, or like, so like maybe, if you can guide over, like, what are the things that you, once you get the data, what are the
Mhm.
things that you work on?
Yeah, great question. Nowadays, the data is actually very good. I mean, back in the day, it was a nightmare to try to acquire high quality data for a reasonable price. Nowadays, it's very simple, very inexpensive. Python has multiple libraries that make it one line of code to acquire decades of price data. So I'm just assuming here for a minute that's what you're talking about, price data. So we've got kind of price data and then all other data, because all other data is actually tricky to come by. Price data is easy. So back in the day, you had to actually scrub the data, make sure that it was of high quality, you weren't missing days, all these kinds of things. Nowadays, really what you're trying to avoid is so-called bias. And imagine the case where you have the S&P 500. So the 500 biggest industrial stocks in the United States. If you were to say backtest a portfolio of the S&P 500 as of today, then you are looking at stocks 10 years ago that weren't in the S&P 500 10 years ago. So if you took a snapshot today and assumed that today's S&P 500 was the same for the past 10 years, that's not the case.
Yeah.
So you are actually introducing survivorship bias. Similarly, like, companies have left the S&P 500, companies have gone bankrupt that used to be in the S&P 500. So you run into this survivorship bias if you're not careful about when you start your data. Like, you just got to be very careful about like thinking about what you're trying to accomplish, especially if you're thinking about a basket of assets. And honestly, that's one of the biggest things that you have to deal with these days. So it's not really like the quality of the data or getting yourself the data. It's more about getting the data as of 10 years ago. And you've got to get like specialized survivorship bias free data sets. And of course they're out there, but you have to pay for them.
Right.
So the free data, you don't get that level of quality. You kind of get what you pay for. But that's the biggest problem that I think people face. Now, if you're talking about like options data, that's a whole nother can of worms. And I know a lot of your audience is probably trading options. Historical options data are very expensive. Futures data, you have to worry about individual contracts and the role and continuous data. So I wouldn't say it's a problem, but it's something that you just have to be very conscious about. So, for example, like when I get stock price data, I just need to make sure that I'm thoughtful about how I'm constructing my backtest. For futures contracts, I just get like individual contract data. Sorry, I'm rambling a bit, but there's a lot here. Now, like futures and options, they expire. So you have like a point in time where they appear and then a point in time where they disappear, and your code has to handle for that. So you can't assume today's options chains existed 10 years ago. That just doesn't work, right? So you've got to kind of be conscious about how the instruments actually trade and how the data kind of comes in and out.
Perfect. So like just curious, like which are few platforms do you take data with? Like if you can share those platform names, or because no, I'll be honest with you. Let's say if someone is starting fresh in the field of algorithmic trading, okay, you said okay, you should get the data. The most of the people they know the go-to source is Yahoo Finance,
Yeah.
because it's the most easiest way to get the data. But definitely, I mean, there are much better sources than that. So, like, what would you recommend if, let's say, someone is starting, right, and they want a good quality data? Any suggestions on that?
I would suggest that. I mean, the if you think about the order of priorities, getting survivorship free data and paying for it is probably not the very first priority. Your very first priority is coming up with a strategy that you think is modeling asset mispricings and market inefficiencies that you can consistently make money with. You can run a survivorship biased data set and just get things running and get things working. And if your performance will be, quite good potentially. And then later, once you're comfortable with building strategies, iterating on strategies, expressing your views in multiple different ways, then you can kind of go in and refine your data acquisition. Unless you've got the money and you're comfortable spending the money up front on something that you may or may not enjoy doing if you're just getting started, this is not easy. So you might get very frustrated and want to quit after 6 months. So if you pay $500 for an annual subscription for data and you're going to quit after 3 months, then that's not a great use of your money. So I would actually suggest just starting very simple, like looking at the historical price data from Yahoo, getting comfortable looking at other data sets, putting it all together, and really trying to understand how to start to model market inefficiencies and start to model these asset mispricings.
Understood.
Now, for vendors, sorry to cut you off, but for vendors, excuse me, Norgate data is a very high quality survivorship adjusted price series for, I think it has US equities, Canadian equities, Australian equities, and futures and Forex. So you kind of have 5 different data sets. It's a subscription service. I think it's like $30 a month, but you have to pay 6 months up front. So it's actually quite reasonable. And then for options data, ivolatility.com. So ivolatility.com has loads of options, historical options data, which you also have to pay for. But you get like millions and millions of rows of this historical chains data, if in fact you want to use options data. Free data is Yahoo Finance. There's a Python library called Y Finance. That's great. OpenBB is an exceptional library, openbb.co. It's one single package that pulls down data from like dozens of different data sources. That's a really great way to start as well.
Perfect, perfect. Yeah, that's a great insight because definitely like getting data, Yahoo Finance, most of the students, they get the data from Yahoo Finance. But at the same time, if someone wants to go into, deep into this, so, what sources like you suggested, like, yeah, definitely is true. People can look into that also. So like
Yep.
moving on to my next question, you mentioned, okay, for the first step is getting the data. The second step is, let's say, building a strategy or a hypothesis and testing that hypothesis. So like how difficult is that step? Because what I think is that is the most difficult step, because creating a strategy and it takes a lot of time. So like what would, like how would you say, like how much time it takes, or it depends on the person to person, or like how tough, how challenging is that process?
It's very challenging. And it kind of depends on your goal. Okay. So think about this. The market is super random, and you might have a 50% probability of making the right decision. Um, let's be what's the word I'm looking for? We'll be conservative and say you have like a 55% probability of making the right decision. If you make 10 trades, that's 55% times 55% times 55% raised to the 10th power. That's a very, very small number. So your overall probability of making a series of correct decisions in a very noisy, chaotic data system is very low. So you've got to be very careful and conscientious about how you are making these decisions and optimize for a high probability of making correct decisions. Okay. Now, all that said, if your goal is to, your goal should be to beat some underlying benchmark on a risk adjusted basis. So what do I mean by that? Well, you can buy the SPY or QQQ ETF tracker and get exposure to these stocks. And the S&P 500 has been 10% a year over a century. The Q's probably something higher, and you can do that for very little cost, no opportunity cost. You just buy the thing and you forget about it. If you're going to actively trade, you want to be doing better than these ETFs. Otherwise, you save your time, save your money, and just sit back and do something else. So if you are trying to actively improve your returns against the benchmark, then you have to do better than the average investor, because the the S&P, these indexes are made up of the average investor in the overall market. So how do you do better than the average investor? You have to have better information, and you have to have better data, and you have to have the wherewithal to action those things. So you need to be smarter than the marginal investor. And you have to ask yourself, do you think you can be smarter than the marginal investor? Better data, better systems, better processes, and then you have to have the emotional fortitude to actually go and execute the trades. So this is all very hard. And then in addition to that, you have to do this correctly many, many times in a row so you don't shrink your probability of having a correct bet over time. So, it's a daunting task, and it takes a lot of time and a lot of attention. So if you think that you can just rock up and 3 months later you're consistently profitable, you won't, right? It's a decade long, not decade, multi-year process to get good at it.
Right. Also, like, so what are some of the mistakes that you have seen, people making in the world of algorithmic trading? Like, any mistakes that you remember, or let's say any of your friends made, or any of anyone, and people should avoid doing that. Anything on that?
Yeah, I mean, algorithmic trading aside, like trading in general, so many mistakes. I think a large part of, gosh, where do I even start? Let me just try to answer your question. So I think the biggest mistake you can make if you're in the algorithmic game is this concept of overfitting. You've got 10 technical indicators, and you brute force your backtesting framework to find the combination and parameter set of these technical indicators that have maximized your P&L, and then you go try to trade that. It's just so likely that you are overfitting to the noise that that's a big mistake, right? So unless you can prove out that you've got this statistical significance over time on hundreds or thousands of trades, then you're probably getting lucky and you're assigning luck to your own skill, and you actually don't have skill. You're just getting lucky. That's probably the biggest mistake. I think the second biggest mistake is what I might call premature optimization, right? So it's very easy, and you're kind of implying it by talking about what data set to go get. People kind of fall into this trap of building out all this technology, building out all the trading screens, building out all the systems, building out all the APIs, building out all the automated processes. And the only thing they haven't done is found a successful winning trading strategy. So I call that premature optimization, and that's another big mistake. And all you're doing is procrastinating, because you're doing the stuff that you know how to do, and you're not doing the stuff that's hard, which is actually building the strategies. So those are probably the two biggest mistakes. And then, there's all sorts of system risk, like, you're in the middle of a trade and your API connection goes down, or, all that kind of stuff that you can get around, but I've seen that happen as well.
Okay, yeah. So thanks, Jason, for walking us through your experience and what is algorithmic trading. Now, I just want to focus because first of all, I want to say congratulations to you on your
Thank you.
book. So can you walk us through your book? Like, what does the book contain? What are certain sections in the book, and how will this book help let's say professionals beginning in the field of algorithmic trading?
Yeah, thanks. Thanks for giving me the opportunity to talk about it. So I released it about a week ago, I think a week ago today, and it's a cookbook style. So what the cookbook style is, it's a collection of so-called recipes, and the recipes are like very kind of independent code snippets that show you how to do a very specific thing. So it's 13 chapters, probably five snippets per chapter, so maybe 75 different snippets. And it kind of takes you through the very basics, like how to download data, how to work with pandas. And then by the end of the book, you're actually like building a trading system. You're actually getting the interactive brokers API set up with Python, and you're running some pretty sophisticated stuff. So if you think about the average user, there's probably a portion of the book that's too easy, and then a portion of the book that's challenging to them. But it's there to take you through the entire kind of process. And it's focusing on the tooling, it's focusing on the Python, We've got things like beta hedging, using principal component analysis, engineering alpha factors, using risk and performance analytics tools, a lot of things that we do in kind of quant and algorithmic trading. So it's kind of designed, or I wrote it for finance people trying to learn Python and Python developers that are trying to learn finance. So it's super practical and really meant to be copy and paste code that you can go and just get up and running right away.
Okay, perfect. Also, like, because I'm sure that you have read a lot of books, because when I see your post on PyCon News, every
Mm-hmm.
post, as soon as I see it, I'm like, so surprised, because you have, given out so many good content, over LinkedIn. So where do you read? Which books do you read, or which books would you recommend, to the viewers? Because definitely one such, because if learning from your book, I mean, that's the best source, but people also want to know from where do you learn. Yeah.
Yeah, I mean, that's a great question. Like all these books, this whole bottom shelf are all technical books. This whole book is all technical books. And I mean, I don't mean to sound like cheeky, but I'm kind of beyond reading the books now. I'm actually reading more about market psychology. Um, I just picked up a book by Howard Marks, who is a legendary credit investor. It's called Mastering the Market Cycle. And he talks a lot about the overall market cycle, right? So the bull highs and the bear lows and how to interpret that. And basically, that's where I'm starting to turn my attention. The other thing I like to read about is there's an author called Marcus Lopez de Prado, and he writes about using machine learning techniques for like portfolio optimization, portfolio management. He's got some books. He's also got some papers out. And then there's a lot of reference books, just like, if you're into financial modeling, so you pick up a reference book on how to do a model, or time series models, more like reference books. Um, but I think the best is just doing and getting into the market and just actually participating in the market, whether it's in a paper trading account or a live account, and just getting that market intuition by actually participating in the market.
Perfect, perfect. Thanks, Jason, for, because I was going through the content of your book on Amazon, and I found it really exciting, to read and stuff. And I was like, yeah, I'll definitely go and buy your book. I have not done that, I would not lie, but definitely, I'm gonna buy that. Okay, so any other recommendations for people who are trying to enter into the field of algorithmic trading? Because a lot of people think, oh, I'll come into this and make a lot of money, and
Mhm.
there are a lot of myths around algorithmic trading. So anything you want to say on that, or any suggestions you want to give to professionals?
Yeah, I mean, it's just about tempering the expectations because I think, as you correctly pointed out, you've got the most competitive arena in the world is the trading markets. You've got, there's never been a time when there's been more ubiquity of high quality data. So you're not going to get any sort of edge pulling down readily available quantitative data because everybody has it. The days of Warren Buffett, Warren Buffett made a lot of money because, 70 years ago, 60 years ago, there, like, the concept of the modeling of investments that we know today didn't exist. And he was literally doing this stuff manually. There was no internet. Those days are gone, right? So there's no free lunch, there's no low hanging fruit. You've got to compete with everybody that's trading. So if you're a curious person and you like technology and you feel the thrill of taking risk and know how to deal with risk, then it's a great opportunity for you. It's probably one of the best. If you're going to get frustrated that something's not working, and you get frustrated when you lose money once in a while, and you are looking for instant gratification, and these things are not good for people who want to trade, right? You really do have to focus hard on it, and you have to spend a lot of time. As far as resources go, I produce a ton of content. I have PyQuant News. I have a newsletter that I highly suggest your listeners. I'm on the 110th issue, 110 weeks in a row. I have a YouTube channel as well, and I just post 5 or 6 minute videos of me walking through some code. Twitter, you didn't mention Twitter. I've got 120,000 followers on Twitter.
Really?
I post
Okay.
Yeah,
Wow.
very high quality content on Twitter as well. And of course, LinkedIn. On my website, you'll find a couple courses. So there's a free course, I offer a paid course, like never ending amount of content. So I think it's a really great way to get a lot of content, very broad and deep content across my socials and my website, without paying anything. You don't have to buy the book. The book's great, but you don't have to buy it. The course is great. You don't have to buy the course. You can get a lot of stuff for free on Twitter, LinkedIn, and my newsletter.
Wow, perfect, perfect. Thank you so much, Jason. Thank you for coming in today. I'll definitely make sure all the sources that you mentioned after the podcast, I do write all those links, attach all those links into the YouTube
Great.
section. So, but really appreciate your time and thank you for joining in today.
My pleasure. Thanks for the great questions. I mean, you say you didn't know anything about algorithmic trading, but you sure seem to know a lot more than you give yourself credit for. So thanks a lot.
Sure, thanks, Jason. Thank you so much.
Cheers. Thank you.